All right, let's look at the world of building a killer investment portfolio. Have you ever dreamed of having a successful investment portfolio but felt unsure about how to make it a reality? You're not alone. Many people aspire to financial freedom through investing, but not everyone knows how to achieve it. When it comes to building a killer investment portfolio, there are several key factors to consider. The first step is to determine your investment goals and risk tolerance. Are you looking to build wealth over the long term, or are you more interested in generating income in the short term? Understanding your goals will help you determine the right mix of investments for your portfolio. Once you have a clear understanding of your goals, the next step is to diversify your investments. Diversification is key to reducing risk in your portfolio. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can minimize the impact of any one investment performing poorly. Another important factor to consider when building a killer investment portfolio is to regularly review and rebalance your investments. Over time, the performance of different assets in your portfolio will vary, leading to a shift in the overall allocation of your investments. By regularly reviewing and rebalancing your portfolio, you can ensure that it remains aligned with your investment goals and risk tolerance. In addition to diversification and regular review, it's also important to consider the costs associated with your investments. High fees and expenses can eat into your returns over time, so it's important to choose investments with low fees whenever possible. This may mean opting for index funds or exchange-traded funds, ETFs, over actively managed funds, as they typically have lower fees. So whether you're a beginner or an experienced investor, the strategies below will help you diversify, manage risk, and maximize your returns. 1. Understand your financial goals. Short-term versus long-term goals. Short-term goals. These could include saving for a vacation, a car, or an emergency fund. Typically, these are goals you want to achieve within 1 to 3 years. Long-term goals. These are goals like retirement, buying a house, or funding your child's education. These goals usually have a time horizon of 5 years or more. Setting SMART goals. Specific, clearly define what you want to achieve. Measurable, ensure you can track your progress. Achievable, set realistic goals. Relevant, align your goals with your financial situation. Time-bound, set a deadline for your goals. 2. Assess your risk tolerance. Risk tolerance levels. Conservative, prefer to minimize risk and preserve capital. Moderate, willing to take on some risk for potential growth. Aggressive, comfortable with high risk for higher returns. Risk assessment tools. Use online questionnaires and risk assessment tools provided by financial institutions to understand your risk tolerance. 3. Diversify your investments. Asset classes, stocks, equities offering ownership in a company, bonds, debt securities that pay interest, real estate, physical property investments, commodities, physical goods like gold, silver, and oil, cryptocurrencies, digital assets like Bitcoin and Ethereum. Diversification strategies by asset class. Allocate your investments across different types of assets. By sector, invest in different sectors such as technology, healthcare, and finance. By geography, diversify your portfolio by investing in international markets. 4. Choose the right investment accounts. Tax-advantaged accounts, 401k, employer-sponsored retirement plan with tax benefits. IRA, individual retirement accounts with traditional or Roth options. 529 plan, education savings plan with tax advantages. Taxable accounts, brokerage accounts, regular investment accounts with no tax advantages but more flexibility. 5. Research and select your investments. Fundamental analysis. Company financials. Look at revenue, profit margins, and debt levels. Management team. Assess the experience and track record of the company's leadership. Industry position. Consider the company's competitive position within its industry. Technical analysis. Price charts. Analyze historical price movements. Trading volume. Look at the number of shares traded. Market trends. Identify patterns and trends in the market. 6. Create a balanced portfolio. Asset allocation, conservative portfolio. Higher allocation to bonds and cash, lower in stocks. Moderate portfolio. Balanced mix of stocks, bonds, and other assets. Aggressive portfolio. Higher allocation to stocks and other high-risk assets. Rebalancing regular reviews, quarterly or annual reviews to ensure your portfolio stays aligned with your goals and risk tolerance. Reallocate assets. Adjust your investments as needed to maintain your desired asset allocation. 7. Monitor your investments. Performance tracking. Benchmarking. Compare your portfolio's performance against market benchmarks. Performance metrics. Use metrics like ROI, CAGR, and Sharpe ratio to assess performance. Staying informed market news. Stay updated with financial news and market trends. Company updates. Keep track of news and updates from the companies you've invested in. 8. Seek professional advice. Financial advisors, certified professionals. Consider hiring a certified financial advisor for personalized advice. Robo-advisors. Use automated investment services for low-cost portfolio management. Tax and legal advisors. Tax efficiency. Consult with tax professionals to optimize the tax efficiency of your portfolio. Legal compliance. Ensure your investments comply with legal and regulatory requirements. 9. Stay committed and patient. Long-term perspective. Market fluctuations. Understand that markets will fluctuate. Stay committed to your long-term plan. Avoid emotional decisions. Don't let fear or greed dictate your investment decisions. Consistent contributions. Regular investments. Continue contributing to your portfolio regularly, regardless of market conditions. Dollar cost averaging. Invest a fixed amount regularly to reduce the impact of volatility. Conclusion. Recap key points. Understand your financial goals, assess your risk tolerance, diversify your investments, choose the right accounts, research and select investments, create a balanced portfolio, monitor your investments, seek professional advice, and stay committed. Action steps. Start today by defining your goals and risk tolerance, then begin building your killer investment portfolio. Finally, when building a killer investment portfolio, it's important to stay disciplined and avoid emotional decision-making. Market fluctuations and economic uncertainty can lead to fear and panic, causing investors to make hasty decisions that can harm their long-term returns. By sticking to your investment plan and avoiding knee-jerk reactions, you can increase the likelihood of achieving your financial goals. In conclusion, building a killer investment portfolio requires careful planning, diversification, regular review, low costs, and discipline. By diversifying your investments, managing risk effectively, and staying disciplined in your approach, you can set yourself up for long-term financial success. If you found this video helpful, make sure to subscribe for more investment tips and check out our other videos on financial planning. Remember, the journey to financial freedom starts with a solid investment portfolio. Thank you for watching, and happy investing.